I'm Oliver Sloup with Blue Line Futures, coming to you from the Chicago Board of Trade with another episode of Tech Talk. It is Thursday, December 10th, and we're not able to get down on the floor for our videos anymore, but I thought I'd bust the corn tie out today as I used to do for the USDA report days. We've got three different markets that we're looking at today: corn, soybeans, and live cattle. We've got the March corn contract pulled up here, so we'll kind of get things started with that. And as you can see, this is the wedge we talked about in the other day's Tech Talk that we've been kind of coiling up in. And today wasn't the catalyst to give us that conviction breakout or breakdown. We continue to lean on the bearish side so long as we can continue to defend lower highs, which is what we did. This is the high we're looking at. This comes in 429 from December 1st. I think the risk reward favors the sell side until we see consecutive closes out above here. A break and close below the trend line is really what the sellers want to see. That would accelerate the long liquidation and I think potentially take us a little closer towards that $3.95 to $4 level. I'm not saying it's going to happen right away, but I think with time we could continue to drift lower. And it kind of goes back to what we've been saying, I think, over the last several weeks, is that this market's going to present a lot of great trading opportunities, shorter-term trading opportunities for market participants on both sides. So we have kept our bias neutral in our daily Grain Express, the commentary that we send out each and every morning, but we're kind of favoring the bear side. But bulls, there's still going to be plenty of opportunities here in the near term as well. Just keep things maybe a little bit tighter in the near term. And soybeans, the same can be said. This is one of those markets too where we've left our bias as neutral, thinking that there's going to be opportunity on both sides of the market, and you really have been. I mean, if you look over the last week, we've been trading 1145 to call it 1170. That's a nice chunk of change for traders on both sides of the market to make some money. We did have a reversal off the overnight highs, and again, take the overnight session with a grain of salt. It's on low volume, and we look for volume to confirm price, and we really weren't able to get a whole heck of a lot when we got into the day session, and we close off those highs and on kind of the lower end of today's range. Again, I think there's opportunity on both sides of the market, but we're continuing to believe we're going to see this market drift a little bit lower. We know that there's a lot of people out there wanting to buy dips, but I don't think the market's going to be making it that easy for them. I've been trading long enough where I know it's never easy to just buy dips in a bull market. They want to squeeze and try to punish people as much as possible. So we're still looking for a little bit bigger of a break and a retracement to this breakout point here from November 10th, which comes in a little bit closer towards 1120. At that point, I think there's a good enough fundamental backdrop where we'd be pretty comfortable looking to the long side, and we've been establishing some longer-term long positions with some option strategies, limited risk, to give us some exposure just in case we don't get that breakdown where we think there's better value. And as far as today's USDA report for corn and beans go, it just wasn't really what the bulls needed to accelerate the market higher. It wasn't overwhelmingly bearish, but it wasn't bullish, and we need to feed the bull market with new news, and we weren't able to get that today. So again, long liquidation towards the end of the year, I think, could become a little bit of a theme here in the coming weeks. But I think ultimately will present some value opportunities to step back in a little bit more aggressive on a directional trade. Now, wrapping things up with the live cattle market. Live cattle held that wedge in the gap that we talked about in the previous Tech Talk video. We didn't get the bounce yesterday. We got the bounce today right on the open, which I think caught a lot of traders off guard. We know that the cash market has softened up this week. We're here in 106 in western Nebraska. So you would have thought that we might roll over a little bit. But if you look where December futures were trading at yesterday, they're in delivery. They're about 107 and a quarter, and that's pretty par for what you might see in western Nebraska. Western Nebraska trades 106, December futures in delivery at 107. That's pretty tight. And so I think, as we had mentioned in previous talks, I think the market did a pretty good job at pricing in a lot of this bad information. Now, does that mean that we're just going to continue to rally and see follow-through momentum to the upside like we did today? Not necessarily. I still have some caution flags up on this February contract, and I really wouldn't be too surprised to see February maybe break down a little bit more. If you want to be buyers and long the market, which we have plenty of clients that do, I think there's going to be opportunities a little bit further out when you look to April and June and kind of establish a longer-term long position from that standpoint. So if that's what we're looking at, that's what you should be looking at too. This has been Oliver Sloup with Blue Line Futures from the Chicago Board of Trade. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors. Thanks a lot.